Good afternoon and welcome to HYCM's online trading workshop with myself, Giles Coughlin, the Chief Currency Analyst here at HYCM. Thank you for joining me during this 1 hour trading workshop. And over the course of the next hour, we're going to be looking at some of the market moving news that's been coming out and looking at how to potentially take advantage of that news and to see where we could enter and potentially exit some of our trades. So we'll be going through some practical aspects of trading. It's a busy trading week, so it's a good opportunity to practice our skills and to put into practice some of the things we've been learning on the Monday with the FX week ahead. Just want to make sure as you're all coming in that you can hear me okay. If someone could just tap in the questions, that would be great, just to let me know that you can hear me and I'm coming over loud and clear. I can see my screen showing, so that's all okay. Oh, thanks, Ali. I'm glad you can hear me. I always like to get the reassurance that I'm able to be heard and I'm not speaking to myself. Before I begin, just important that I just go through the disclaimer at the beginning. And the key thing about this disclaimer is to understand the whole purpose of these webinars is not to provide trading advice. So I'm not providing a signal service or signals that you copy or anything like that. The whole idea of these webinars is that you begin to learn to put into practice some of the skills that I'm using in order to make you an independent trader. So you can trade for yourself, you can make your own decisions, and in time you don't need someone like me because you know what you're doing and why you're doing it. So that's just to make it clear that this workshop is educational. If you have a demo account, open up the demo account now, and we can practice, some of the aspects of entries and identifying which pairs to trade. So if you've got your demo account, that'd be really perfect, and it gives you an opportunity to kind of try and have a go yourself if you're just beginning to trade, or if you're even if you're advanced, maybe there's some entries that you haven't heard of before. So just have your platforms open and ready. Just going to outline the session ahead now. Before we begin, if you look at the handout charts on the GoToWebinar control panel, you should see a triangle that says handouts, 1 of 5. It's a slightly grey, it's a grey box, white writing on my screen. And if you click it open, the workshop guide, what you should get a workshop guide that looks like this. And this workshop guide just lets you know what we're going to go through during the course of the hour. Now, I like to keep it the same, so I've chosen 5 major titles. If you look at free online trading workshops, if you look here, the titles of the individual sections all start with look back, look forward, look at the charts, look at your risk, look at the outcome of your trade. And this all fits on one side of A4. So the whole idea is that I'm going to go through this sheet with you today, and when you take this sheet away, you print it out for yourself, put it on your trading desk, put it by your side, and you can go through it yourself so that you begin to put these skills into practice on a day-to-day basis. These 5 things are things that I just do automatically now. I do them almost without thinking, but especially when you're beginning or you haven't quite got that routine down, it's important that you follow this routine, because these key headings will be good reminders for you when you're trading, that you haven't missed any major aspect of it. So 1, 2, 3, 4, 5, just print it out, and we'll be referring to this sheet as we go through this workshop. But just to let you know, try and use that on a day-to-day basis. And then the whole idea is you can come back next week and you can say, well, you can either mention on your questions or just let me know, send me an email, let me know how you've been getting on with using the handout and how your trading's been going. Now, have a look here. Special topic today. Each workshop we do something a little bit different, and today with the Japanese markets being on holiday, it's a perfect opportunity to look at the topic how to spot a flash crash environment. Flash crashes are occurring more frequently in the financial markets as of late. And there's a specific reason for that, and we're going to look at how to spot the times when they're more likely to happen, and how you can, try to avoid those situations and avoid getting caught up in a flash crash. So that's the special topic for today. Email suggestions for topics, just email them to me at giles.cochran@hycm.com. Any email that you send me for a topic, I'll read it. That goes directly to me. And if it's a topic that I think is going to be helpful for us, then by all means, I will cover that topic. So if you want a topic, email me. Now's your time. If there's an aspect of trading or the markets that you don't get, then just let me know. Okay, Ali, okay, yeah, okay, Ali, thank you. One of the questions just come up from Ali. What's a flash crash? That's a great question, Ali. Now, a flash crash is a sudden, extreme movement in the currency markets, and it's called a flash because it's sudden, and it's called a crash because it's an extreme move. So a flash crash is when a currency moves very quickly, very fast, and it moves a long way, okay? And one of the difficulties with flash crashes, Ali, is that people's orders don't always get filled at the price they wanted. So it means that maybe you put your stop loss at, say, 110 on the US dollar Japanese yen pair, but say there's all of a sudden there's a flash crash and there's a lot of yen buying, you might find that your stop order was filled at 109.75, 109.80. So avoiding a flash crash is a very helpful thing to do, and there are certain times when they're more likely to happen. I'll go into a bit more detail when we go into the topic, but that just gives you a little bit of an idea, Ali, what they are. Flash, sudden, crash, extreme. So it's a sudden extreme movement in currency price. So without further ado, please turn to your handout and we will start to run through this and look at how we could take opportunities. So here we go. The first thing we do under the look back sentiment title is we identify recent sentiment. And we want to read up on the last 2 sessions of market activity. And then we want to identify the key market sentiment and try to summarize that sentiment in a sentence or 2. Okay, so what we're trying to do is we're trying to see what is it that the market is most focused on at the moment. And if we're trading intraday, that's going to help us to develop a bias for a certain currency to trade. What we're trying to see is what are the reasons for the market's currencies moving in the directions they are. That's what we're trying to establish. So currency trading, currencies move for a reason. It's not just all arbitrary or just all technical movements. The movements are driven by fundamental reasons, central bank forward guidance, monetary policy, as well as geopolitical concerns. There's a whole range of different issues that move the markets. We want to see what is it that's moving currency and the commodities market at this particular moment in time. So we're going to start by looking back, and when we look back, I wanted to do a quick recap on oil first and foremost. We've been looking at the oil charts last week, and what we noticed is there was some really bullish news for oil last week, that the US were no longer going to waive Iran's sanctions for certain importers, okay? So that's the people that receive oil from Iran. The US had said that they'd waived Iranian sanctions for certain importers, but now they're saying we're not going to do it anymore. So in other words, that was seen as bullish news for oil because it would mean less oil supply in the oil markets. Less supply equals more demand, and so less supply means higher prices rather, okay? Because you've got the same demand, less supply, higher prices. Now in September 2018, the US was expected to be tough on Iran, but they gave lots of waivers. So now they're reversing those waivers that they gave. And Secretary of State Mike Pompeo announced to the media that as of May the 2nd, that's coming up 2 days, the State Department will no longer grant sanction waivers to any country that's currently importing Iranian crude or condensate, okay? So this should provide a decent bid for oil. That's what we've been expecting, with Iran currently exporting about 1.2 million barrels. And the key areas to watch that I highlighted last week was how much will Saudi Arabia and UAE be able to provide. That's the issue. In other words, if the Iranian oil supply is cut out of the market, will Saudi Arabia just be able to replace that instantly? So we'll be looking at some of those questions have been, partly answered, and we'll see how the market's been responding. And the key areas to watch is India and Russia importing Iranian oil. How much would they increase their imports? Here is the key importers of Iranian oil by destination. So China is a key importer, India, China, then we also have Japan, and we have other nations. That's presumably going to be Russia is going to be one of those other nations. So looking at the latest oil news, so this is going right up to this week. The Saudi energy minister said earlier in the session, almost every oil minister wants to extend the global output rates. So in other words, those OPEC cuts, Saudi saying that all the oil ministers want to extend that. And Saudi says that they're ready to meet the consumer demand and replace Iranian oil, adding that Saudi will not voluntarily exceed oil production levels set in the global deal. So they're saying, okay, production's still around, production cuts are still on the cards, and Saudi Arabia are ready to take over the shortfall from Iran's waivers in the sanctions. Now, looking at the oil chart, this is the daily oil chart. We see this ascending uptrend. And what we saw when I was preparing for this webinar, we saw the price is just testing the underside of that daily uptrend. You can see the technical line there. That break on Friday was a key technical break. So this now becomes the key line in the sand, this area here. And if you just drill down to the daily chart, you can see that price fell down to this resistance level. Now that was a key area of support on the oil chart because we got the bullish news out of Iran. So we know that there's going to be bids on the oil chart. Now I wasn't expecting the oil chart to go down this far. And I wasn't expecting it to move back, but it has moved back yet, and it's found support on the resistance level. So if you, so if you see that is that the underside of the trend line. So we're literally just testing that key area here, which is around the 63, 64 mark. So it's around the 64 level is the key kind of technical line in the sand now for oil. We'll come back to oil later because we've got some more news that came out just in the European session. But I want to do a quick recap on where we are overall. Okay, now on Friday, Trump had a Twitter alert. Now Trump does like to tweet, particularly about oil prices. And what he tweeted on Friday was that he said he called OPEC and told them to bring prices down. Now, quite who he called, I don't know, because the OPEC isn't like there isn't a number, there isn't a king of OPEC, as it were. There's a group of countries. So Trump is saying that he wants lower oil prices, and oil prices did fall on the Friday. Now I don't know whether that was Trump tweeting. He has brought oil prices down before, or whether it was the concerns that Saudi Arabia will be able to just replace Iran's output flow. We have got some more bullish reasons for oil at the moment, and we'll get back to that in a moment. Seasonally, just to be remembered that May is not such a seasonal good month for oil. You can see here that February, March, and April have been very good months for oil historically. Oil is quite a seasonal commodity. And you can see October, November, December, you tend to see oil falling in price. February, March, and April, you tend to see oil appreciating in price. Now, I'm not saying that we should trade oil just based on this chart, no, but I'm saying it's helpful to have the information to our hands, and May can be a very weak season in oil, but you can see there are some notable exceptions as well. The red is when oil has the percentage that oil is lost during the month, the green is the percentage that oil is appreciated during the month. So you can see there's some pretty large down moves, and there's the odd good up move in May, but the general trend in May is not as good as February, March, and April. So that's just to bear in mind. In the US session, end of yesterday evening, my time, we had the US March personal consumption expenditure core just dropped a little bit down, 1.6% rounded up, 1.55% unrounded. And just to remember that the US dollar kind of sold off, even though there was a strong GDP data beat on Friday. Now, the GDP data came out at 3.2% versus 2.3 expected on Friday. Now, you think that would be a really good number because, well, look, 3.2% is nearly 1 whole percentage point higher than was expected for GDP. However, the problem was, and it's a problem that's happening across the globe at the moment, it's happening in the UK as well, is the source, the reason for that GDP data beat was due to inventories and trade. So you can see that net trade added around 1 percentage point to the GDP, and inventories added 0.65 percentage points to GDP. The inventories are building because of the US-China trade war. Companies, factories are getting inventories. They're making sure that they're getting as much product created. They're getting in raw materials. They're stockpiling in anticipation of tariffs or trade disputes. So that has artificially increased the GDP. That's happened in the UK, it's happened in the US. So markets are focusing not just on the headline figure, but on the detail. And one of the concerns about the inventories and trade factors driving the GDP is that just as those have gone up, they can also decrease. And in time, they will decrease because companies won't need to have so much inventories in the coming months because they've already filled them. So that means GDP down the line is more likely to fall. So that's what markets are reacting to when they see that. Don't forget, we've got the Federal Reserve meeting tomorrow, so the dollar is very much in wait and see mode. No rate moves is expected at the next federal meeting. So what's priced in? Well, you can see there's a 22.8% probability of a rate cut priced in for the June meeting. I think that's I don't think that's very likely, but that's what the market's pricing in. So we have to see what the Federal Reserve's FOMC minutes say. So if we get a more hawkish minutes, we're going to see that probability of a cut being priced out. Okay, so just to be aware of that. In the Asian session overnight now, the standout event was China's overnight PMI data. Now that was a miss across the board, okay? So the manufacturing PMI missed at 50.1 versus 50.5 expected. The services PMI data came in at 54.3 versus 55 expected. And the CAGSEN PMI release came later. And that is the private Chinese PMI release of small and medium companies. And there was a miss there of 50.2 versus 50.9. Just remember, when you're looking at the Chinese data, the manufacturing, the services PMI, this is the official data. The CAC-SIN PMI, that is the unofficial and private Chinese data. So this tends to be smaller, medium companies. This PMI data, manufacturing services, tends to be the large government-sponsored, government-funded and supported companies. So that's the difference between the two. And they missed across the board. So for those of you who've been following these webinars for some time now, just let me ask you a question. What currency will we expect to see react given these weak PMI data? What currency would we expect to react given these weak Chinese PMI data? Well done, Nadir, you've got it right. Well done, Aaron, well done. Good try. Okay, excellent. Nadir, Aaron, you got it spot on. It's the Australian dollar. Because about 30% of Australia's GDP is made up from its export to China. So when the Chinese economy is struggling, the Australian dollar is going to struggle. When the Chinese economy is booming, the Australian dollar is going to benefit. Think of it, like one of those big sharks, and you see the shark in the ocean, and you see like a smaller fish just swimming underneath it. The idea is that when the big shark's doing well, the smaller fish is doing well as well, because he's living in the shadow of the big shark. In a way, Australia's economy is in the shadow of China's economy. Now, Chinese economy contributes, I think, around it's about 15%, maybe a little bit more of the world's global GDP comes from China alone. So you can see the impact that would have on a smaller nation like Australia. So these weak data points have resulted in some Australian dollar weakness. So this is why I was looking at shorting Australian dollar this morning. Now we'll have a little look at the Australian dollar chart, and we'll get you guys doing a bit of work here. So let's have a look. Here's the Australian US dollar. Okay, so we saw, right, this is what we saw. This was the large sell-off in the PMI data. So we saw price dropped over the course of now 0.7067 down to 0.7032. Now, say you came to the market like I did, came to the market around 7 a.m., just opening up my news terminals, just reading what's going on, and price was around here, testing 0.7033. Okay. Now, looking at that chart, we'll flip to the intraday chart. We'll go to the 15-minute chart. How would you have gone about organizing an entry into this trade if you wanted to get into this trade? What level would you potentially looking to enter? So this is handing it over to you. I'll give you a slight clue. Get your Fibonacci retracement tool, draw it from left down to right, okay, and tell me where would potentially you have looked at an entry on that pair. Give me some levels, guys. Give me some of the places we're looking at. Okay, great, Nadir, well done. Okay, 61.8 retracement. Yeah, that could have been a great level to short the Australian dollar from, and I pair it with the US dollar, seeing some sort of broad US dollar weakness. Now you've got the FOMC coming out tomorrow, so that's kind of in wait and see mode. We've got a bit of month end taking place, a bit of position squaring. Things are generally quiet, but yeah, 61.8 would have been an ideal entry. Yeah, Sammy, yeah, 61.8, that's good. Now, why might you have done it a little bit lower? What is around that area as well? Ali, the 23.6, yeah, okay, I'm with you, Ali, got you. 38.2, that's possible. Now this is the, yeah, that's all good. Now, what other aspects are we looking, remember, when we're looking for an entry, we want as many different factors together as possible. So we want to think, is there an option expiry level going on? We want to think, where's the intraday resistance? So we look at the intraday resistance, let's draw it in. So there we've got intraday resistance there. You see the intraday resistance, support, resistance, resistance. So look, oh, and look, what's significant about this number? What is that number around? Can you see it's 0.705? It's 5.1, but that means it's in the region of the big round number. Remember, any time in the markets, when you get a 00 or a 50 number, they have, yeah, Sammy, you got it, a round figure. Okay, so we're looking at this. We're starting to put this together, aren't we? So we've got a Fibonacci retracement. We're looking at the resistance level here. We have the big round number there. Now, what other things do we have? Let me show you. We have some other things. This is some information. So where is it? Yeah, okay. So this is what I posted. You can see I posted this morning at 7 a.m. This is a post that I made, and I identified this region here, the 0.7050 region, and I'll show you what really confirmed it for me was seeing. Let me just see. I think I've got the screenshot here. No, it's not that one. Try again. No, right. I'll just show it to you on a different chart. I'll just do a quick screenshot for you. Right, here it comes, and this is right. You can see here that pivot point there was. Do you see? So at the intraday resistance, at the 50% pivot point, Fibonacci retracement point, at the big round number, and at the pivot point. Do you see there? Yeah, let's. I wasn't really looking at the moving averages, Sammy, although they are kind of in that region. You've got the 100 exponential moving average as well, so that that's not gonna harm us at all. So just going back to our chart, and you can see that the Nadir, the 61.8 entry would have been perfect. It would have been better than the 50% entry because you've got more points, so that would have been very good as well. And you can see again that is at playing at those intraday resistance levels here. You can see resistance, resistance, resistance. Oh, no surprise, it's resistance. Now, where would stop placement be? Where would you want to put your stop? Have a look. Where would we want to put our stop here? No, I wouldn't put. Oh, you mean take? No, I wouldn't put my take profit at 23.6. I'm talking about stop. Where do 70.70? Yeah, Nadir. That's the first stop placement would be above the 70.70 here. Okay. And now what we can do is we can now reduce our risk because you can see that the trade is beginning to move in our direction. Okay. So we've got a swing point. We've got a swing point here, a swing point there. So we've got two swing points. So we can now reduce our risk and just put our stop above this swing point here. And then we want to target a projection of 1 times what we're, our entry. So I'm looking for a target just above the 0.70 level, so about 0.7018 target. And then I'm looking very carefully and trying to trail my stop once we start testing these lows here. Okay, so we manage it from behind. So we can see we've got our entry, we've now got our swing point. Another potential place to put our stop would be above the 50 exponential moving average on the 4-hour chart, or above the 200 exponential moving average on the 1-hour chart. So we could put it just above 0.7070. But that way, if price goes back over that level, we know we're wrong. Okay, so we're not going to be in any doubt. We think, okay, yeah, we're definitely wrong if price goes up to that level. And now it's just a question of managing the trade as we're moving towards our targets. This is the first, potential area to look to take profit, which is at these lows here. So that's the kind of key thing. And we've got the FOMC coming out tomorrow. So either way, we want to be out of this trade or at break even by the time the FOMC minutes are released, because there's going to be movement, there's going to be a whipsaw. So either way, we're out of this by tomorrow. Okay, but that's just a good example. Well done, guys. Good good answers, good entries. Remember to start putting those things together. If there was an option level at that at any of these points, that would have been a really good another contributing factor for us. Okay, let's return back to what we're looking at. As I said, that was like a good opportunity that just presented itself this morning. Okay, Brexit is on hold at the moment because there's no Brexit issues tabled for UK Parliament this week. It is a quiet week on the parliamentary front, but there are cross-party talks continuing, and there have been some positive headlines this morning. Okay, so this is one to watch. It's been getting quite tiring with Brexit, and but the headlines are coming out again, and this time there's some reaction on the pound this morning in the European section, and basically the UK's Lidlington said that Brexit talks with Labour were positive and productive, and there was another report from a Guardian political correspondent, Jessica Elgott, who said that she understands that Labour talks with government are more positive than expected from last week's discussions, tone markedly different, and seems now clear grounds to continue talking, but definitely not a breakthrough yet. So there has been some growing confidence from the Brexit talks that there will be some cross-party agreement. Now, there's a lot of incentive for the Conservative Party to get a cross-party agreement before the European elections. And part of that reason is there's a party in the UK called UKIP. This man, Nigel Farage, really took UKIP to new heights in the UK political scene. He's now opened a new party after having left UKIP. And the idea of this new party is to make sure that Britain does leave the EU. And if the Conservative government hasn't got a deal sorted by the time the European elections occur, and there has to be sort of European MP votes, we're going to see a lot of people voting against the Conservatives and voting in line with Nigel Farage. So there's a lot of risk at the moment with the pound around these elections coming up, and that's why Theresa May is desperately trying to get these cross-party talks sorted before then. So watch this space. And what we've seen is this. Let's quickly look at the pound. Let's look at the pound technically. Let's flip over to the pound now. Pound US dollar. Let's see where we are. There we are. Right, so here's the pound US dollar, and you can see the pound has been appreciating all morning. It has just been steadily being bid on these headlines and dollar weakness, and you can see that the pound is now heading into a real technically key area. We have a collection of the moving averages, the 100, the 50, the 200. That's going to provide some resistance. We also have this ascending trend line. And there we can see that the price broke through the trend line, tested it, sold off. Now price is retesting that trend line. So this is a key, a pivotal point for the pound. And similarly, we can see that this descending triangle that's been broken out. So potentially, if we see a technical break of the upside, notwithstanding any news, that does indicate it's another technical break to the upside. But if we see a resistance, a sell-off from this area, and I would expect some selling at this point because of the stiff overhead resistance that's up. But just to make it clear, if we do get a Brexit breakthrough, the obvious target would be up to 1.32 as a first target, then 1.36, and ultimately onto 1.4. So if there is a Brexit breakthrough, the first target would be these highs here, 1.32, which I think we should go through quite easily. And then my target would be 1.36 here at the 200 exponential moving average on the weekly chart. So obviously stops could be just placed just below the low here. So let's say suddenly you get you know, a news report that says cross-party talks, you know, successful, something like that, then you could quickly make an entry with your stop just below the low, and we could see 1.36 would be that, you know, would be a rational target, a second target above those weekly highs there. So just to be aware of that news, just chipping away, and also be aware we're at this technical crossroads here. So this isn't a place to, you know, I'm not suggesting a trade, but you can just see that this is a key technical crossroads on the pound. And don't forget the pair. Just because the Brexit deadline is being pushed forward to October the 31st, there's still potential opportunities. So watch out for that pair. The European session, we also had some German inflation data. That's what all this detail is here. You see Saxony, Brandenburg, Bavaria, North Rhine-Westphalia. All of these areas are German regions. So a lot of these German regions released their own individual CPI data. They came out in the European session, and it was pretty good. You could see that nearly all the independent regions had a beat, and Saxony, which tends to mirror the German CPI data as a whole, so in other words, what happens for Saxony tends to mirror what happens for the whole region. Okay, so that's why traders focus on the Saxony result particularly, and that came in at plus 0.9% versus 0.5% month-on-month prior, and the year-on-year reading was good. This is the core year-on-year reading because it doesn't include energy, and that core reading came at 1.7% versus 1.1% versus 1.1% of last month. So good beats, good readings for the Saxony region. And then we had, so Germany stayed CPI upside bias, solid improvement, inflation pressures, core reading of 1.1. Yeah, we've gone over that. Now, the thing to remember about these CPI readings, and it's worth bearing in mind, is wherever Easter is, it does impact the Eurozone inflation reading. So if you notice on this chart here, when you have like an early Easter, you tend to see a fall in inflation. So an early Easter here, 31st of March, 27th of March. So when Easter is, you know, falls at different times in the year. The holiday is calculated at different times. It's all to do with you know, it's all to do with the last full moon there is, and then the Easter is organised in a different way. So when it's early, you tend to get a dip in Eurozone inflation. So you can see here, 2013, it was an early Easter, and the inflation dipped. Similarly here, 27th of March 2016, you can see that Eurozone inflation dipped. But when it's a late Easter, look at 20th of April, 16th of April, you tend to see an uptick in inflation. So the place of Easter impacts where how the inflation data unfolds. So we're now in a late Easter. So we were expecting a strong reading, and that's what we got. So the Germany April preliminary inflation data came out at 1% versus 0.5% month-on-month expected. And what we saw a buying the rumor, selling the fact kind of trade going into this April preliminary CPI data that came out in the European session. I'll just run that through you so you can see it for yourself with your own eyes. Let's just make sure that the euro, yeah, there's the euro still a pair. And what we saw is this so we saw from this morning, you know, from going from 6 a.m. as these independent, you know, inflation readings are coming out from the German region, we saw that price was bid all the way up, and then we see that it's 1 o'clock, just around 12 o'clock, 1 o'clock, we had the German CPI data come out, and then traders took some profit. That's why you see this tailing candle. And now, so that's a buy the rumor, and then they were selling the fact, which is just closing those positions because the expected inflation data came out as expected. Now we can see price moving up again. One of the interesting things, there is a large expiry option level about 1.1240 to 1.1250 that expires in about 20 minutes. So that's a large spot option level. They tend to operate as magnets, so that's drawing price to itself as well. But you can just see, you can look at this in your own time and look when the CPI data came out for the different regions. And there's some euro relief. There's a record euro short positions. So some of those positions are just obviously taking their profit, and it's quite oversold conditions. And the inflationary data is better, so it makes the market less concerned that Europe's in a recession, and the recovery in the Germany CPI data is welcomed. It's welcome news. So that's the euro-US dollar pair. Just to give you a heads up, European CPI for the whole zone is coming out on Friday. Now, just as Saxony, is the main reading for Germany, Germany is the main reading for the Eurozone. So you can expect, some good CPI data on Friday. So that could be a buy the rumor type opportunity, where in anticipation of this good data, the euro is bought. So if you can find a good level and a good pair to trade, obviously you've got to make sure you trade it with the correct pair. We've got the euro-US dollar, we've got the FOMC minutes coming up on Wednesday. So it's not a trade to get into now, but it's worth looking. Friday, May the 3rd, we know that this CPI data is probably going to be good. It's probably going to beat that 1.6%. That's certainly the market expectations. So be aware of that, and also be aware of buy the rumor, sell the fact. So if it is really good, you might get traders taking profit on it as well. So just to be aware of that phenomenon, and that's really come out of the German data that we've seen this morning. There was talk about China says trade talks with US have achieved much positive progress. There's been more positive China-US trade talks progress, but not much detail. So you just have to remember that with the Chinese-US trade deal, it's a very political deal, and it's in both countries' best interests to make positive sounds that a deal is coming. However, the reality of working out a deal is quite difficult, and this is a genuine power struggle between the world's two largest economies. It's a power play, essentially, and how that gets worked out is going to be tricky and difficult, but both countries want to keep making positive sounds that it will be worked out because it's in both their interests. However, I've got you a little bit of a reading because I haven't got time to go into all of this detail now. It will take too much time, but I found a good article for you on the BBC, which I'm going to send out to you all now. And that article there will give you just a little heads up on some of the relationships between US and China and why it's complicated. I won't say any more on that, but we still haven't got the details of any trade deal between those two countries. Now, breaking in the European session, and this is what bid up oil, was that there's a military coup in Venezuela. Now, this military coup in Venezuela has been pushing oil prices higher. Now, let me explain why. This is OPEC's website, and you can see that this is the OPEC share of world crude oil reserves. So you can see that OPEC has around 81.89% of the entire world's crude oil reserves. And of those OPEC countries, we can see that Venezuela, here in the orange, has the largest portion of OPEC proven crude oil reserves. So we've got nearly 25% of the world's crude oil reserves come from Venezuela, from the OPEC share, and then Saudi Arabia is 21.9%. So if there is, a military coup in Saudi Arabia, in Venezuela rather, that's going to be driving up oil prices, and there is some, concerns that there's that it's being reported on Reuters about a military coup. Okay, so that's a further sentiment that's bidding oil. So if you're looking at US oil and short-term sentiment, okay, look at the US oil chart, and here we have the US oil chart. Now, if you can remember that intraday trend line, okay, and what we see on that intraday trend line, this is there. Okay, I've drawn a Fibonacci retracement point on this chart. Now, price has moved since I last done that, so I'm just going to put a fresh one on, and then we'll ask ourselves some more questions. Okay, now. Yeah, okay. Just getting this for you now. It's a bit cramped, but we can still see it. There we go. There we go. Right. Now, if this carries on, we're going to see some further oil price being bid. Now, if we were looking to go long on this oil chart, where would be a potential entry for us? I know it's cramped, but if you look at the trend line, the pivot point, and the Fibonacci retracement, where would be a potential entry to go long here? You could also look at the moving averages. Have a look. Here's one without the pivot points on. Slightly easier to see. Where would be a potential long on this chart? That's a Fibonacci retracement. So we've got the Fibonacci retracement level there. We would be looking at, guys. We've got the ascending trend line on the daily chart. So that's the trend line that's working as a crossroads. Okay, let me help you out here. So potential entries, we could have a potential entry down here at the 50%. We could have a potential entry here at around 63.60, 63.70 region with our stops just below here, about 63.50. We could have a potential entry at this point, which you also have the overhead resistance, which now turns support. So that region there looks quite good for some support. We also could enter on a deeper retracement back to this support level at the 61.8 Fibonacci retracement level with stops just below the low there. The other entry that we potentially could have is a tighter entry just above the resistance 1 point. So you could trade a breakout of that resistance level with a stop very tight just below the low in case prices reverse. So that's a couple of options that you could potentially have on US oil chart long. Obviously the breaking news here is the Venezuelan military coup news. So we want to see if that coup gets crushed and nothing comes of it, then we're going to see oil fall back down. But if the coup is going to be disrupting supply of the oil, then we saw what a huge percentage of OPEC's oil reserves come from Venezuela. That is obviously going to push up price. In the European session, as it closed, we saw pound was the strongest currency pair, and we had some strength in the Japanese yen as well. Yen pairs, probably a little bit strengthened on that poor data that came out of the Chinese PMIs, a little bit of risk aversion, seeing a bit of yen strength. So looking forward, now at the time of doing this webinar, we had Bank of Canada GDP data. That has since come out. The Bank of Canada took a double stance at the last rate meeting, and they reduced their 2019 GDP forecast to 1.2% from 1.7%. And Governor Pollock said they will be data dependent going forward. So this GDP obviously comes into focus. It was a miss. The miss was minus 0.1% month on month versus 0.0% expected. It's a relatively minor miss. And drilling down to the detail, a lot of the miss came from mining and quarrying, excluding oil and gas. So those mining and quarrying, particularly of metals, was down at minus 4.4%. And obviously, if global growth sentiment picks up, then those figures will reverse because there'll be more demand for metals. So it's a miss, but it's not a disastrous miss for Canada at all. And particularly with that miss mainly coming from mining metals, then we should expect to see that potentially reverse, especially if the US-China trade deal gets sorted. So there wasn't anything to particularly cheer up or depress the Canadian outlook. So that came out. Looking ahead, we do have some Pollock speaking at 3 o'clock. So be aware of that. That's coming up shortly. So he could obviously comment on the GDP, and he might comment on rate hikes or rate cuts. So, obviously if you're trading the Canadian dollar, you need to be very careful around that event. Potentially listen to the speech. There could be opportunities for trading the speech. We also have coming up out of New Zealand, we have employment change and unemployment change. Now this is only quarterly. So there has been an increase of last week on speculative funds who have gone long the New Zealand dollar. Okay. Now the outlook for the Bank of New Zealand is bearish because they said they're more likely to cut, and this employment data is going to be significant. So keep an eye out for it. If that's a big miss on the employment front, then we'd expect to see the New Zealand dollar sold off quite heavily. So keep alert, and it's worth setting your alarm and looking for that data point. If you got a deviation of plus 0.3% or 0.4%, that would be an instant New Zealand dollar sell. And tonight I would pair this with the New Zealand dollar US dollar pair, because we know that the FOMC is coming tomorrow, so there's not going to be particularly any big movements on the US dollar. Before the FOMC, it should be quite quiet. So just to be aware of that. That is coming up, potential good opportunity for trading. If you miss the trade, but it's a big deviation, again, you can look to trade it on a pullback. Notwithstanding the FOMC data coming out tomorrow around 6-7 o'clock UK time, British summer time. So that's something to be aware of. We also have the inflation data out on Friday, which has greater importance now, given the German CPI data which we've seen. So that is anticipation of being a good figure. So when it's a good figure, we know it's the anticipation of a good figure. There's a potential buy the rumor, sell the fact trade in that situation. Yeah, Nadir, positive China talk would be positive for the Australian dollar. It would. If there's something really positive out of China, that will be positive Australian dollar. Now, looking at the charts, this is where we develop a bias for certain currencies. We've done this as we've gone through. We've looked at a bias for the Australian dollar. We looked at a bias for US oil. We've looked at a potential bias for the New Zealand dollar looking ahead. So what we want to do in this situation is, once you've done your analysis, go through the different currencies, go through the different pairs, go through the different stories, and try to pair up weak and strong currencies and then write them down. So literally write down the currencies that are weak, write down the currencies that are strong, and try and pair them together, and then look for key technical levels to enter. Okay, so that's the way to marry the currency pairs together. Then look at your risk. We've covered that in some detail before now, so I won't talk about that now. However, we'll go on to, with just 5 minutes remaining, but that is enough time for how to spot the conditions of an Forex FX flash crash. Now, the FX trading day is split into 3 main different time zones. You have the London or European session, which is, 8 a.m. through to 5 p.m. GMT time. You then have the New York trading session, or the American trading session, which is 1 o'clock GMT to 10 o'clock GMT. And then you have the Asian overnight session, which is from around midnight through to 9 a.m. GMT time. Now, if a flash crash is going to happen, the most likely time for it to occur is in the time between New York leaving the market and before Tokyo enters the market. So the particular concern at the moment has been that with Tokyo's Japanese markets are closed at the moment for 10 days. They've got another 4 trading days. They'll be closed next Monday and then opening again on Tuesday, the 7th of May. And what the concern has been that with Tokyo completely out of the market, this leaves a big gap. Now, the problem with gaps, it means that traders, banks, funds aren't executing orders in the market. And it's these absence of orders which ironically create a lot of difficulty. Because when there's not many orders in the market, you might think, oh, well, that means the market just stays still. Yeah, it does tend to have a narrower range, but it also, there's a possibility of price moving much more, dramatically on a lot less, for hardly any reason at all. So it's called an illiquid market, and you can get large moves for no particular reason, and it's due to a lack of orders being in the market. It's called a liquidity gap. So in other words, if someone's trying to get a fill, they might have to go down 10 points, 20 points, 30 points, 40 points before they can get a fill on their price. This means that on our price charts, we will see large movements. If you look at the price on the Sunday Open, you'll often see gaps and jumps. Okay, so just go to the market, Sunday Open, have a look at the different pairs, and you'll see these gaps and jumps and big moves and fast moves that happen just as the market opens. That's an illiquid market, and an FX flash crash, if it's going to happen, it will happen during those illiquid markets. Because if you get a large order that enters or a sudden order that enters in a illiquid market, you can have very large moves. And that is the condition for an FX flash crash. It's when you don't have many people in the market. So it's not likely to happen in the European session or the New York session because there's plenty of orders, okay? And yes, you might get fast moves and large moves, but not to the extent of a flash crash where you see 400, 500 points in like 5 minutes. That's really what a flash crash is. So when they happen at this time here, at the end of the New York session and before Tokyo gets going, a lot of people have been talking about the danger of flash crashes recently because of the Japanese markets being on total holiday until Tuesday, May the 7th. So that's something for you to keep an eye on. So the currency that will be affected in this flash crash most likely will be the yen. And the yen could be bought quite strongly. So you don't want to be short the Japanese yen at this time. So you got to be careful of holding your yen positions overnight. And some funds have just, you know, stopped their yen positions over this period because of the added risk, and they, you know, they are not engaging in yen positions. That is the danger of a flash crash, and that's how to spot it. The end of the New York session before Tokyo gets in, Tokyo away, be cautious until the European market opens up first thing GMT 7 o'clock in the morning. Guys, that is all we have time for this week. Don't forget that there is a service that's offered here at HYCM, and this is a service that comes free with a deposit. So if you deposit $1,500 into your trading account, you get a 1-hour coaching session with myself. If you deposit $3,000, you get a 1-hour session with myself and a 1-hour trading follow-up review. That's a really helpful package. It's a very, you know, it's good to have the session and then good to have the hour follow-up review. And finally, the premium, you get the 2-hour coaching session, the follow-up review, and you get 1 week VIP support. So that is basically opportunity to email me, ask about different currency pairs, you know, maybe ask some of the questions that you'd like to ask, but, you know, just haven't got someone to ask. You could ask me that with the premium. So they're the services we offer. And don't forget, we do the FX week ahead on the Monday, but it's a UK bank holiday next Monday, so I won't be here this Monday. However, I did have that in mind when I prepared the FX week ahead for this Monday. So if you go back and listen to the recording, I do cover a couple of the significant events that are coming next week. We've got a Reserve Bank of Australia rate statement, and we've got a rate statement for the RBNZ as well. So I covered both of those in this week's FX week look ahead. So if you go back and listen to the recording, you'll see something helpful for next week. Otherwise, I won't be here next Monday. However, I will be, as usual, here next Tuesday to take you through a workshop and help you guys in your trading. Hope that's been helpful. Thank you for the different responses that I've got. Well done, a number of you, for recognizing good entries and you know, getting the stops and beginning to get this down. Don't forget, use the handout. You're welcome, Nadir. Use the handout on a week-to-week basis and keep practicing these skills. And if you just started, then practice this on the demo account. Go through the different questions. They're there designed to help you, and you'll slowly start putting this together. Come along to the workshop and you'll just slowly pick up knowledge all the while, and you'll grow in your understanding. Okay, guys, thank you very much. I hope you have a really good week, and I hope to see some of you guys a week on next Tuesday. Yeah, thank you, Aaron. Take care now, guys. Goodbye.